COVID-19 may have caused you to defer or push back your mortgage payments, but with that comes consequences. In this short video, I'll share with you what happens after a forbearance period ends. My name is Kandy.Katz. If you're new to my channel, welcome. Be sure to hit that subscribe button and hit that bell also to let YouTube know that you love this video. How many of you have gone through forbearance? Jimmy didn't know that he was signing a deferment agreement with his loan servicer. Jimmy, whose income was affected due to COVID-19, wanted to take out a cash-out refinance on his home mortgage. During this time, he experienced some life changes. He has a baby on the way. So that led him to say, all right, this is time to go ahead and see what I need to do to tap into my equity. Upon him applying for the loan, he provided, all of his necessary docs. We got the file pre-approved, and at that time, we learned that there was a second lien on his home. So what does that mean? When you're paying into your mortgage, ideally that's a first mortgage that you're paying, whether that's with Loan Depot, Chase, whoever the servicer is. Then, if you have a second lien taken out, that must mean you had refinanced your house to tap into your equity, which is a home equity line of credit. Maybe you took out a second mortgage. In this case, Jimmy wasn't aware that when he signed his deferment agreement during COVID, he was signing that he was responsible for what he delayed and what he suspended his payments, because there's three ways you can address how you deferred your payments. One is you're going to be paying the balance in a lump sum that you deferred. So when your forbearance period ends, whether that's 6 months, 12 months, whatever was agreed upon, that's when your lump sum is due. Number two is you would pay additional on top of your monthly mortgage. So your payments of $2,300 a month maybe will increase to say $2,350 for the next 120 days, whatever that agreement was. Then number three, you would actually be paying the lump sum due at the end of the loan. So even though your balance is $300,000, towards the end, that deferred period that you didn't pay your mortgage during COVID was a sum of $30,000, you have an additional $30,000 to pay. In this case, Jimmy had a silent second lien. So even though he wasn't paying anything additional a month, it actually is due now that he's trying to refinance and take cash out. So in his case, he was looking forward to receiving $60,000 in cash, now is only $40,000 to create that nest egg for his soon to be born baby and also prepare for, life's unexpectancies. Be sure to check with your lender first so that your payoffs on the mortgages can be requested. And for more refinancing tips, be sure to check out my series. Thanks so much for tuning in, and I'll see you on the next one.